There are three financial mistakes that quietly destroy more wealth than most market crashes ever do. What makes them dangerous is that people usually don't realize they are making them until it is too late. By the time the recession is on the front page of every newspaper, by the time markets are falling and fear is everywhere, the opportunity to prepare has already passed. That is why I want to talk about these three financial moves today. Not because I know exactly when the next downturn will arrive. Nobody knows that. But because economic cycles have existed for hundreds of years, and there is no reason to believe they have suddenly disappeared. Every generation eventually faces a period when confidence turns into fear, when easy money becomes scarce, and when investors discover whether their financial foundation is strong or fragile. One of the biggest mistakes people make is assuming that because things have been good for a long time, they will continue to be good indefinitely. Human beings naturally project the recent past into the future. When markets rise year after year, people begin to believe rising markets are normal. When jobs are plentiful, people assume opportunities will always be available. When asset prices climb, people start treating appreciation as a guarantee instead of a possibility. History shows this thinking is dangerous. Every major financial cycle eventually reaches a point where optimism becomes excessive. That is usually when risk is highest, not lowest. The first financial move I believe everyone should consider is building true diversification. I know diversification sounds boring. It is probably one of the most repeated ideas in personal finance. But sometimes the most repeated ideas are repeated because they are true. The problem is that most people misunderstand what diversification actually means. They think owning several stocks is diversification. They think buying different companies within the same market is diversification. Often it is not. If all your investments rise and fall together, you are more concentrated than you think. Imagine someone owns 10 different technology companies. On paper, that looks diversified. In reality, many of those businesses may respond to the same economic conditions. When technology performs well, all 10 may rise. When technology struggles, all 10 may fall. The investor feels diversified during good times because everything is moving upward. The illusion disappears when conditions change. Real diversification means owning assets that behave differently from one another. Some may thrive during growth periods. Others may provide stability during recessions. The objective is not to maximize gains in every environment. The objective is survival. One lesson that financial history teaches repeatedly is that nobody consistently predicts the future. Experts fail. Economists fail. Professional investors fail. Markets are influenced by millions of variables that no individual can fully understand. If predicting the future perfectly is impossible, then basing your entire financial plan on a prediction is dangerous. Diversification is valuable because it acknowledges uncertainty. Instead of trying to guess exactly what will happen, it prepares for multiple possibilities. Think about the people who entered previous recessions with all of their wealth tied to a single industry, a single market, or a single trend. Many believed they were making a safe decision because recent performance looked strong. Then circumstances changed. What seemed safe became risky almost overnight. Diversification is not exciting because it accepts that nobody knows the future, but that humility is exactly what makes it powerful. The second financial move is maintaining exposure to assets that historically provide protection during periods of instability. For centuries, one asset has repeatedly played that role: gold. Gold is often misunderstood. Some people dismiss it as an outdated relic. Others treat it as a speculative investment. Both perspectives miss the point. The primary purpose of gold is not rapid growth. Its purpose is protection. Most financial assets depend on promises. Stocks depend on businesses generating profits. Bonds depend on borrowers repaying debt. Bank deposits depend on financial institutions remaining stable. Gold is different. It does not require a company to succeed. It does not require a government to maintain credibility. It does not require a borrower to honor obligations. It exists independently of those relationships. This characteristic becomes particularly important during periods of uncertainty. When confidence in financial systems declines, investors often seek assets that are not dependent upon the same promises supporting traditional markets. That is one reason gold has survived for thousands of years despite enormous political, technological, and economic change. Empires have risen and fallen. Currencies have appeared and disappeared. Financial systems have been created and replaced. Yet gold has remained relevant through all of it. That does not mean people should put all their money into gold. Concentration in any single asset creates risk. A balanced financial strategy requires growth assets, income-producing assets, and defensive assets. Gold belongs in the defensive category. It is not designed to generate large cash flows. It is designed to provide resilience when uncertainty increases. Think of it the same way you think about insurance. Insurance is not purchased because you expect disaster tomorrow. It is purchased because you understand that unexpected events occur. Something interesting has happened over the last several years. Central banks around the world have steadily increased their gold reserves. These institutions managing enormous resources analyzing financial risks. Their actions do not guarantee future outcomes, but they do suggest that many sophisticated decision-makers continue to see value in maintaining exposure to hard assets during uncertain times. However, diversification and protection alone are not enough. This brings us to the third move, and in my opinion, it is the most important one. It has nothing to do with what you buy. It has everything to do with how you behave. The greatest threat to most investors is not the market. It is their own psychology. Confidence is everywhere. Friends talk about investments making money. During those periods, people convince themselves they have a high tolerance for risk. Then the cycle changes. Suddenly emotions take control. Fear is one of the strongest forces in finance. It causes intelligent people to make irrational decisions. It convinces investors that temporary declines are permanent. It persuades them that selling during panic is a form of protection. Unfortunately, this emotional reaction often produces exactly the wrong outcome. Consider what typically happens during a downturn. Prices decline. Investors become uncomfortable. Some sell because they cannot tolerate uncertainty. After selling, they wait for conditions to improve before returning. The problem is that markets usually recover before confidence returns. By the time everything feels safe again, prices have often risen substantially. Investors end up selling low and buying high. It is one of the most common financial mistakes in history. What makes this pattern particularly frustrating is that people rarely recognize it while it is happening. Every downturn feels unique. Every crisis appears unprecedented. Every negative headline seems convincing. Yet when we look back, the same emotional cycle repeats again and again. This is why preparation matters so much. If you wait until fear arrives to decide how you will respond, emotions will probably make the decision for you. Instead, the decision should be made in advance, before markets decline, before headlines become alarming, before anxiety takes control. One of the most valuable habits an investor can develop is accepting that volatility is normal. Markets do not move upward in straight lines. Economic growth does not occur without interruptions. Corrections and recessions are not evidence that the system is broken. They are evidence that cycles exist. When investors accept this reality, downturns become easier to navigate. A falling market no longer feels like a shocking event. It feels like something that was expected. That shift in perspective can dramatically improve decision-making. Instead of reacting emotionally, investors can follow plan. Another important idea is understanding the difference. between temporary declines and permanent losses. A decline becomes permanent only when an investor sells and locks it in. Until then, it remains part of a larger cycle. This distinction may sound simple, but it has enormous implications. Investors who understand it often remain patient while others panic. Patience is not passive. It is a deliberate decision. It requires confidence in your strategy and acceptance of uncertainty. The most successful long-term investors are not necessarily the smartest or the most informed. Often they are simply the most disciplined. They understand that time is one of the most powerful forces in investing and that emotional reactions can destroy years of progress. There is another side to downturns that many people overlook. While they create fear, they also create opportunity. When markets decline, high-quality assets frequently become available at lower prices. Investors who have prepared properly and maintained emotional discipline may find themselves in a position to take advantage of those opportunities. Throughout history, some of the greatest fortunes were built not during periods of optimism, but during periods of pessimism. The reason is simple. Opportunity often appears when confidence disappears. The challenge is having the courage and preparation to act while others are focused on fear. When we bring everything together, the framework becomes straightforward. First, build genuine diversification so your future does not depend on a single prediction. Second, maintain exposure to defensive assets that can provide stability during uncertain periods. Third, and most importantly, develop the emotional discipline required to stay rational when others become emotional. Notice what all three steps have in common. None of them require perfect forecasting. None depend on knowing exactly when the next recession will begin. None require predicting interest rates, election results, or market movements. Instead, they focus on preparation. Preparation is one of the few advantages available to every investor regardless of age, income, or experience. The future will always contain uncertainty. Markets will rise and fall. Economies will expand and contract. New opportunities will emerge while old assumptions disappear. These realities cannot be avoided. What can be controlled is how we prepare for them. The people who emerge strongest from difficult periods are rarely those who guessed the future correctly. More often, they are the people who accepted uncertainty, built resilient financial foundations, and maintained discipline when conditions became challenging. They understood a simple truth. Successful investing is not about predicting every storm. It is about building a ship capable of sailing through one. The window for preparation always exists before the crisis becomes obvious. Once everyone recognizes the danger, most of the valuable decisions have already been made. That is why calm periods are so important. They provide the opportunity to think clearly, act deliberately, and position yourself for whatever comes next. No one knows what the next few years will bring, but history suggests that change is inevitable. Economic cycles will continue, challenges will appear, volatility will return. The question is not whether those events will happen. The question is whether you will be ready when they do. And that readiness comes down to three simple principles: diversify intelligently, protect strategically, and remain emotionally disciplined. Those principles may not sound exciting. They may not generate headlines, but over long periods of time, they have proven far more valuable than any prediction ever could.